Hi there, this is Chris from MoneyHub, and this video looks at debt consolidation loans. So debt consolidation loans are quite popular. They're advertised heavily, usually by personal lenders, and the idea is that you bring a whole bunch of different debts in, and rather than trying to manage all the repayments of those, you then convert those into one debt, and you pay that off slowly until it's all cleared. It sounds good in principle, but there are a few things you need to know, which is why this video is being put together, to just sort of explain everything in a very sort of clear manner. So first of all, we've published a very comprehensive guide to debt consolidation loans. I do suggest having a read through it. I'm going to sort of build out the summary of it now, and you can find that below with the link. We've also got some other links to related loan guides should they be needed. So just as a background, as I said before, debt consolidation is a process that involves moving multiple debts into one debt, which is then repaid with one single payment ongoing. So it's likely to be beneficial if you have a manageable level of debt and you don't plan to take on any new debt. So this is for people who have, a whole bunch of things like store cards and credit cards and personal loans. That's what it's primarily aimed at for consolidation. You can't debt consolidate things like student loans or student debt, mortgages, overdrafts, or anything like that. Car loans, you can't really do that, but you can do a whole bunch of other things that are kind of unsecured debt. So where the savings come from is designed to be the lower interest rate. So say if you're paying 20% on a personal loan, 25% on a credit card, and possibly say 15% on a store card, you may get an offer, say for example 17.99% for debt consolidation, and that's likely to be cheaper if you average in all your debts and what you're paying than what you currently are. But of course you need to properly compare exactly what you are paying, because it might be that the interest rate isn't cheaper, and it is better just to continue to pay off the debts as they are. So that really is the trick. And it's certainly, debt consolidation, as we've seen here, is not a magical solution for debt problems, and it's not going to solve your spending behavior, which means these debts have come about, and there's certainly no judgment here, and it's no one's intention to get into lots of debt. But if you do a consolidation, they will, that money will be used to pay off your credit card or your store card or all of them, or your personal loan. But then you do have a risk there that you might put things back onto the credit card or back onto the store card, or get out another loan or things like that. And that can, cause more debt. So it's kind of like a balance transfer credit card, whereas, the money goes off onto a lower interest or zero interest account, but then you have to repay it. That's how it works. Otherwise, you're just going to end up with more debt. We have talked about it's not going to help if you're in a debt crisis. So if you're having huge amounts of money, huge amounts of problems, trying to pay back money that you owe, then debt consolidation probably isn't going to be the answer, just because you're likely to need some help or some support around hardship, and we've got a completely different guide to that, which I've also linked below in the video. Now, if we just go through into the options for debt consolidation, there's the standard way, which is the fixed rate loan, and that's what most people advertise. Most lenders, and you'll see those. It's just designed to bring it all together, and just like a personal loan does. So you'll be going in at a fixed interest rate with a repayment. It could be over 2 years, it could be 3 years, over 4 years, 5 years, etc. And then you just get a schedule of repayments, and you make sure that you make those payments. The other option is for debt consolidation is a balance transfer credit card. People don't really see that as a debt consolidation per se, but actually that's exactly what it is, and I touched on that before. So if you have a store card, or if you have some credit card debt, then you can look around for a balance transfer option and move it all over to there. They are popular. The approval rates, are not that high, especially because of CCCFA. like the new government regulation about, debts and credit. But it's certainly worth considering because you can get very low offers, i.e. at 0% or perhaps 1.99% for say 6 months, 12 months, even 24 months at some times. So that is a strong option if you just have credit card debt and you want to consolidate that, as the term would be. Another option is homeowner debt. So what you can look at, and this has long-term costs, but it can be a lot cheaper in the short term, is basically taking some sort of equity release or line of credit from your home, usually known as a revolving mortgage. So rather than having a whole bunch of personal debt, but equity in your property, you could take out say $10,000-$15,000. This isn't financial advice. This is just an example, and then put that towards your debts and clear them off. Now you may be paying 15, 20% or 25% on these consumer debts, these personal debts. You can consolidate them on your mortgage. Maybe your mortgage is 5-6%. The issue there is that you'll be paying that mortgage off for a lot longer than say the 2, 3, 4 years that the personal loans were, or the credit cards. So just be aware that that has a short-term lower interest cost, but long-term that may cost a lot more. So it's really just about balancing what your options are. No one likes managing a whole bunch of debt repayments. That's just not really what people want to be doing. So we do see the value in debt consolidation loans, but at the same time you really have to be careful with what one suits you, because you don't want to be paying more for the sake of convenience. And so it really does come down to comparing the total cost of the loan. So not just the interest rate, but the time that you'll be paying it back. That's really going to drive what the best options are. So calculating the right amount to borrow, this is a really important step of the process. Now that you're if you are considering taking out the debt consolidation loan, the first step is to add up the exact amount that you need to borrow. So that's going to be all your sort of debts that that you can consolidate. So not your student loans or anything like that, and car loans, but just your standard credit cards, store cards, personal loans. And then you need to decide what the payback period is going to be. So if you say, for example, as we've written here, $20,000, and you're going to take 4 years to repay it, then you have to look at what the what the schedule of that looks like. Can you afford to make those repayments? And because sometimes credit card debt isn't repaid, it just rolls in and you make the minimum repayment, and so that means that to actually pay it off, you'll need to be upping those repayments from the minimum, which is usually around 5 or sort of 2-3-5% of the balance, to some really sort of significant repayments. So that's for you to decide there, and just calculate it with like a debt repayment calculator, which I've also linked down below in this video. And then you also have to sort of make a consideration for sort of unexpected events. So we always say to multiply the estimated repayment period by 1.5, just because it's going to give you some buffer. You never know what's going to happen, and you don't want to be really squeezed on making these repayments sort of every week or every fortnight or every month. It gives you a little bit more flexibility. Yes, you'll pay more interest costs overall, but you won't have the stress of perhaps having to get new debt in the short term, because you're having a struggle trying to make the current debt consolidation repayment. So whilst it is annoying to know that you are going to be paying more interest, it gives you flexibility and a bit of breathing space. So that's certainly something to consider. Now, the next steps are shop around for the lowest interest rate. That's really the big driver here. And the lowest interest rate is the percentage, and that's going to be the biggest influence on how much you pay. Fees for these loans are not that significant. Maybe you pay a setup fee, maybe you pay a monthly fee for managing it or something like that. But it really does come down to the interest rate, and make sure you compare, like for like. So look at all of the offers and But before that, before you go straight into it, do look at the balance transfer credit cards, because you may be able to move some debt from there quite cheaply. And you could, if you have a few loans or a few debts, like store cards or credit cards, that's a good way to do it. And then if you have other personal loans sitting out there, then you can also run a debt consolidation loan as well, to incorporate those. It really just depends what your financial situation is and what your debts are. And that's why it's going to come down to a bit of consideration. But certainly don't rush into anything, because you're going to be locked into these loans for 1, 2, 3, 4, 5 years. So make sure you do the research and get a full comparison of the market before switching or doing anything, because it's going to, this is not going to be a cheap process. But the idea is to get everything paid off in that time and not take on any more debts. So what we've done here is just listed must-know facts for the debt consolidation loans. The first step is, please try and polish up your credit history before applying for a debt consolidation loan. So if you have anything, marked there, or anything that's contentious or not correct, then that can be, negative for what you're going to be offered. So we've got a very comprehensive credit score and credit report guide that tells you how to get your free credit history, and then you can then challenge things if they're not correct. So just be aware that you might have something marked, and of course lenders want to lend to the best possible candidates or applicants. So make sure everything's looks correct before you actually apply, because they'll see the information that's in your history, and it does need to be right. And so there's no point having something in there that's wrong, because it's just going to cause a higher interest rate or get you denied. Second to that, know the debt consolidation limits before you apply. And the reason that that's written there is that there's no point coming along and asking for huge amounts of money that you can't actually get. So most most unsecured debt consolidation loans are between 1 and 5 years, and that's just how it is. They don't go beyond that, because that's not really a personal loan kind of term debt. That gets into kind of long-term sort of mortgage debt, which is not the purpose of a debt consolidation loan. So 1 to 5 years that's going to be your usual time span, and the amount that you can borrow. Some go up to 70,000. I see things all the time with sort of people asking just sort of advice. Of course, we can't provide it, but people do have higher debts than you think, but they still manage to get debt consolidation loans. So just know the limits, but you'll probably be fine. If you've got under $70,000, you should be able to find someone who'll lend at that sort of level. But of course, the smaller or the lesser the debt, the better. That will give you more options. And then you really need to look at how much debt you have as a percentage of your total income, where you've got 50, so more than 50% of your income is actually debt, a debt is 50% of your income, then that's going to be a problem. So for example, if you have $30,000 of debt, but your pre-tax income per year is $50,000, that's about 60% of your income being debt, and that's quite high. So if that is the situation, then it is worth looking at making a financial hardship application, because that debt has almost become unserviceable if it's not already, and that means that it's likely you'll be able to get some debt relief. I mean, of course, every case is different, but if you are in any doubt, we strongly suggest contacting the Citizens Advice Bureau, and they work with a whole bunch of people all day long, and a part of their job or part of the services that they offer is negotiating with people's lenders to kind of strip out some of the debt or get some sort of repayment breaks or things like that. So certainly worth an option, or certainly worth considering there. Now, this sounds obvious, but I'm going to state it here. It's what we say is, please only consolidate debts that have a higher interest rate than your consolidation loan. There's no point taking out a debt consolidation loan and putting money into it for a loan that has a lower interest rate. So if you currently have a personal loan at 9.99%, but your new consolidation loan that you've been offered is say 13.99%, then you'll be paying more to pay off that 9.99% loan. There's no point whatsoever to do that. That's just going to cost you more money, and there's just no winners from that whatsoever other than the lender who's lending it to you. So don't do that. It's got to, the rates of interest for your debt consolidation loan have to be lower than your current debt. So if you can't do a balance transfer credit card, if you can't do anything like that, then your store card or your credit card may be about 25%. But then if your debt consolidation loan is say 15.99%, then that's a smart move because you'll be paying much less sort of interest. But yeah, never go the other way because it's just going to cost you more money. And then we also say that putting credit card debt with a loan is not the best idea if you already qualify for a balance transfer credit card. We just think balance transfer credit cards are the way to go there. So always look for those first. Don't just think, oh, I've got all this credit card interest, so I've got all this credit card debt. It's a nightmare. I can never pay it off. I'll just get into a debt consolidation loan. Because the reality is, no, you might find that it's much better and much easier to change it to a 0% balance transfer. Those are more common than you think. As I previously said, they can be tricky to get approved, especially now with government law changes, but I would strongly suggest considering them because you can get a 0% or a very low interest rate versus what a debt consolidation loan will be, which will be much higher. Now, finally, sort of moving on to the finer points, you must repay the existing debts with your debt consolidation loan. There's no purpose to just take that money and go and spend it. That would just be insane. As soon as you get the money, apply it to the debts. That's the purpose. You do not want to be tempted, and you do not want to get into more debt. It's satisfying just to clear them as soon as possible. And sometimes lenders won't follow you up on that because it's not really part of their remit. But the onus is on you, or the responsibility is on you, just to pay them off and be totally done with them. Chop up the card if need be. Close out the account. Don't take on any more loans with the lenders that you've paid off as part of your debt consolidation. Just basically cancel it. So you've paid it off. That's the end of the story. Otherwise, you can get trapped back into these debts, and it's just not going to be a sustainable long-term solution, because taking on more debt to pay off debt is that only works when you do not take on more debt. Which brings me to my next point, that you really need to have a plan for to cease running up new debt. So as I previously said, and this is quite a good little section here, cancel all credit card and the store cards that you've transferred the debt from, and then do a personal budget. We've got lots of guides in MoneyHub for that, and just set your sort of discretionary spending and learn to say no. But most importantly, please make sure you keep up with the payments or the repayments for the debt consolidation loan. Please always have the money for that. That's your focus to get it all cleared off. People do manage to do it, but it all comes down to willpower and self-control. So really just be very, very strong with that, because debt consolidation loan, it shouldn't drag out, it shouldn't be rolled over, it shouldn't be extended, it should be paid off when you per the original schedule. And then just some last points here. Please don't consolidate debts if you're close to paying them off. That's really just gonna drag out the debt. So if you're very close, you've got 3 months left on a small personal loan, and then you don't want to bring that balance into a new 2-year, 3-year, 4-year debt consolidation. It's best just to work it out, pay it all off, and then move on, because otherwise you're going to risk just having that debt hang around for longer. And it's a very good feeling to pay off the debt. So just stick to that. If it's got less than 12 months and it's manageable, just keep it there, because even if the interest rate's slightly higher, I know that's a little bit contradictory to what I previously said, but like overs and unders, it's probably going to be cheaper to do so. We strongly suggest considering a budget advisor. They're absolutely fantastic. I've met so many of them in my time at MoneyHub, and they will help you. They're free. They're all over the country. And so strongly suggest setting that up, because you can get debt free. They will help you. They will sort you out. They'll even talk to your lenders if there is any issues, and you can just get a big step up. And they want to help you. There's no judgment. You know, if I had any issues with debt consolidation or anything like that, the first people I would go to would be a budget advisor all day long. I can honestly say you'll be completely supported, and you'll be very, like, there's absolutely no downside to doing so. So please consider that. And then, as I said, kind of touched on, stay strong and have the willpower to make the repayments. That's the only way this is going to work. You've got to stay strong. You've got to say no to wants, and you've got to get these debts paid off. Sorry to sound very naggy, but that's how debt consolidation works. So what we've done is we've listed here a whole bunch of different lenders. This is based on their interest rates, you know, what they offer. And we've also said that, you know, the alternatives are going to be the balance transfer credit card and the revolving credit mortgage, or things like that. So just have a look through there. We've got some frequently asked questions. Actually, just before I say that, we do constantly update the rates here. So if you're looking at, you know, the guides, you know, whenever, like, you'll see like new interest rates, that we're always updating them just to, you know, make sure people know what they are. The lower the interest rate, obviously the cheaper the debt consolidation loan, but not everybody qualifies for the low interest rate. So that's why we say make sure that your affordability is strong, that you're minimizing expenses, and you're generally just, you know, cleared up your credit history so that there's no surprises on there or nothing negative. And that's going to give you the best chance of a low interest rate. But yeah, the less money that you can spend, and you know, the better, because that will just make you more attractive to a lender, which means lower interest rates. So that's really the answer of how do I get the lowest rate on my debt consolidation loan. And then, do debt consolidation loans hurt your credit score? The answer really is it depends. If you miss repayments, then that's going to be an issue. But if you pay well and you don't, you know, fall into arrears or anything like that, then, you know, that should be some positive reporting there, and, you know, so there'll be no negative, you know, reporting. And then a question that people do ask is like, well, is it a good idea to consolidate my debt, or should I just like pay them off as I, you know, have them already? And this, again, it will depend on the total interest cost, like what you're offered versus what you're currently paying. So whilst it may be convenient, as I said, if you're going to be paying a higher interest rate over a longer time for a loan that you already have, that's quite a low interest rate and not much time to go on it, then no, we would probably say not worth considering, or not worth going like ahead with a debt consolidation loan. But it all comes down to your personal debts and your situations. So how much do they actually cost, these debt consolidation loans? The answer is there probably will be some sort of application fee, normally $100 to like $250 is the standard range. But just, you know, just be aware that, and if you do a balance transfer credit card, you may have to pay for like the credit card's annual fee. So just keep that in mind. These fees can be added on to the total loan. So you'll just be repaying them when you repay all the debt that's being transferred over. Can you get a debt consolidation loan with bad credit? This also depends. It really just is going to come down to how credit worthy you are, and how much you can afford, and what's your history. So, and then people also ask us, well, what is the best debt consolidation loan? And the answer there is the one with the lowest interest rate. That's likely to be the biggest consideration and the biggest driver of value. So yeah, just be aware that, you know, interest rates range. You may see low numbers, but that's why we say please compare with everybody, because what you see advertised is not necessarily what you'll get. So please just make the applications and make an informed choice based on the total cost of the loan. And then what happens if you can't actually make the repayments once you've got a debt consolidation loan? Well, that's going to be a matter to talk with your lender, and we've got some very useful information in our debt help guide. So that's something that can happen. It does happen, of course, and you can look for a hardship application, or you can look for a holiday, a repayment holiday. And for this reason is why I say it's really a good idea to set up some meetings, with a budget advisor. It's free, and they can be almost like your financial sort of debt-free coach, and sort of help you in times of hardship or any sort of repayment difficulties. And then finally, so what is the overall purpose of consolidating debts? The answer is to pay less interest and get rid of the debt. Now, if you don't do that, if you decide to consolidate the debts but then actually just take on more debt through a whole bunch of things, through bad habits, then you're not going to get ahead and you're going to have more debt. So please be very wary of that. We've got some final thoughts here. It's not something, debt consolidation is not something that you want to be doing every year. It's something that you want to do as a kind of a circuit breaker. Just get rid of the debt, and it should be a one-off task that you take some time to research and then go straight into, choosing a preferred lender with the lowest rate that meets your repayment needs or means, and then shift it all and stick to a plan. We really can't say enough how brilliant it would be to work with a budget advisor. I just wish everybody did that are in these situations, because they will help you. And then, of course, avoiding debt while you're repaying it is such an essential element, because otherwise you face the risk of just taking on more debt and having to repeat the cycle and always be paying off debt, which is absolutely miserable. So thank you very much for watching. I know it's been a big slog to be able to get through this out, but this is something like an area which is very, very prominent on MoneyHub, and we're very conscious of the fact that there's a lot of consumer debt out there. We suggest that if you have any questions, you can either write to our email, which you can find on the contact page of MoneyHub, but you can also leave comments down below in this video, because we're very responsive to videos. We like when people leave comments. It helps us to improve our guides, our information, our tools. So feel free to do that, and we will be able to respond pretty quickly. Thank you so much, and do let us know if you have any questions.